Hi, everybody. My name is Eric Kropp, Senior Product Manager here for Experian Business Information Services. I want to welcome you to today's Sip and Solve session entitled 4 Risk Scoring Options to Help Modernize B2B Credit Approvals. And as is customary for any Sip and Solve session, we always recommend joining us with your favorite beverage or morning beverage there, whether it's coffee or some espresso to help get the day started. I myself start my day every morning with a Dunkin' Donuts coffee with a little almond milk and some sugar just to get the day started right. Unfortunately, I couldn't go out to Dunkin' Donuts to actually go grab it as I normally do throughout my week, just due to everything going on, unfortunately, around COVID-19 and everyone taking precautions to stay at home. So definitely an unusual bit of circumstances, but I appreciate really everybody attending today, whether you're from your home office or wherever you can join. We also want you to be aware, too, we really hope everybody is staying safe and healthy out there, not only just you, but also your families. And Experian here is trying to proceed as best as we can to provide services and support to all of our clients during a very difficult time. So we look forward to your participation today and obviously your continued partnership. That being the case, I wanted to jump into our session today, which is really going to be focused around risk scoring. And I was really excited to do this session today because it was a continuation of another session that I had done a couple of months ago for Sip and Solve. And it was really about modernizing your path to improving B2B credit approvals. And within that session, we discussed a 5-step framework really intended to help clients manage and improve or modernize their B2B credit approval process. And here's kind of a stepping staircase here where you can see what those steps look like that we had discussed. And they actually provided a lot of great insights into different things and different levers and services and best practices that customers could implement within their process to make or to go on that journey and to modernize their process. Today's session is really going to be focused on making that first step, making that step from perhaps you're a shop that's more manually review oriented, looking at credit report data in its entirety, really combing through those reports and looking for ways to start driving some efficiencies, start maybe looking at ways to improve your throughput around application processing. Perhaps there are those out there looking to improve customer experience and workflow automation, all very common trends and themes that we see going on today in the industry space. And the concepts of risk scoring that we're going to talk about will really help you to make that first step and will provide you with some good things to think about as well as to consider. That being the case, I wanted to talk about why score-based automation. Why is that important for a lot of companies that are looking to take this first step to modernizing their approval process? And I think this is really shown well by this diagram that you see here at the bottom of the slide. You can see it almost looks like a traffic light. It's a colored bar. It's got red, yellow, and green. And this represents the number of applications or 100% of the applications that are perhaps coming into any given business at a particular period of time. And by using the concepts of risk scoring, where instead of looking through a full credit report to determine risk, you're actually looking at key data attributes and perhaps using a score value to determine where you're going to make some of your baseline approvals and baseline declines. And it's not necessarily when you first get into this, and of course I have some clients that are very heavy in automation. In fact, they automate every single transaction through risk scoring that comes in to their business practically. And I have others that are much more conservative. And for folks that are first starting this journey, one of the key recommendations that we always put out there is to consider using risk scores really at the extremes of that application population, looking at it more for how can I approve my low-risk clients, those no-brainers that should definitely be low risk. Based on scores, we can give them a credit limit recommendation immediately. And where can I easily find or determine my high-risk customers? And just as an example, as you see here in this diagram, if I were to apply risk-based scoring automation at the top 10% for my low-risk customers and the bottom 10% for my high-risk customers, that's 20% of my application base that I could potentially automate And if I'm working in an environment where I'm looking to move away from manual reviews or looking to better focus my staff, I could take my team of credit analysts and focus more on that manual review category in order to free up that time and to become more efficient and effective in that business process. And so when you look at how you could potentially apply this, this is where a lot of companies start to see gains in their day-to-day process. And as this ramps up over time and you become more comfortable with concepts around risk scoring, you start seeing the benefits, stakeholders start to buy in more. Over time, you start to see those extremes start to come down more into that yellow area, and you can even automate further as you become more comfortable. And that's typically the path we see a lot of clients take once they become more comfortable with it. The other thing to keep in mind, too, is you'll also see an increase in consistency and objectivity with your decisions. Before you were having a lot of analysts making independent decisions, you may get some variance into how that aligns with your overall strategic direction or strategic credit policy. So moving to something like this, you can also see some of those differences. But this really answers the question of why I would maybe want to start considering using more of a score-based system. And if you have convinced yourself this is the direction I want to go, these are some other things I want you to start thinking about. 4 different options at your disposal immediately that you can start considering to start making these adjustments. One of the first things that you can start thinking about using is something called generic scores. And from a development standpoint, these scores are statistically based, meaning they're based on some level of statistical analysis that is done. It's typically generated by perhaps a third-party bureau, someone like Experian, but there are also multiple other data providers out there in the marketplace, or perhaps a third-party data science type company that builds these types of scores. And the scores are typically referred to as all industry, meaning they're built on a representative sample of the general business population. So they consist of all industries, all types of businesses. And so when we talk about deriving risk or assessing risk off these types of generic scores, it's really intended to benchmark against the general business population as far as performance. And the purpose of these scores is to define the probability of a specific outcome, or what we often refer to in the industry as a bad definition. And some of the more common ones you find in the B2B commercial credit space are around severe delinquency, such as maybe 1 times 90 or 2 times 60, perhaps around more of a severe condition of will I even get paid at all through bankruptcy, default, or failure risk. And those are very, very common. And on the left-hand side of this screen, you'll notice I included 2 generic scores just as a frame of reference here that Experian BIS provides to a lot of its clients. IntelliScore Plus is a delinquency score, and Financial Stability Risk Score is more for assessing the risk of bankruptcy and default. And below in that image, I've also included some what we call default risk classes and risk bands. And you can probably start to pick up really quickly by using a generic score. There are some really key advantages, mainly the fact that I can easily get access to this data and I can implement a scoring strategy around these generic scores in almost an off-the-shelf manner. Typically, they're already included in a lot of the base credit reports that you're already accessing today. And as you look at the score, it's relatively easy to interpret. So for instance, I can look at a score value and determine what type of risk class it falls into based on the model performance as high risk. And if I have any type of performance tables or charts associated with the model, I can get an idea of what the probability of that bad definition or outcome might be, such as what is the probability of delinquency? What is the probability of bankruptcy or default? And that makes life a lot easier when you're just starting to adopt a risk scoring strategy. A couple other things to keep in mind, too, is that these scores are built off very comprehensive data sets. They're validated on millions of business records. They also will simultaneously assess multiple risk attributes at the same time. So anytime you see a score, you could be assessing up to hundreds of different data attributes simultaneously. So it's very comprehensive from a risk management standpoint. Like any type of option, there are pros, but there are also maybe some challenges that you might encounter with adopting something like this in your very own process. One of the things that we may run into is the fact that these types of scores are usually oriented around credit attributes from a specific data set or a credit report. In some examples, you may have a situation where you look at other things beyond that, so this score may not be the end-all, be-all to making a final credit decision based on your process. You may be looking at other types of items such as perhaps financial statements. Another thing to think about too is compatibility. Generic scores are modeled off the general business population. So you may find edge cases or corner cases that come up where we score something or the score is representative of a certain way of looking at risk, whereas you look at it somewhat differently. And sometimes those edge cases and corner cases can be difficult to manage in your process, and some will work through that if they're using generic scores, and others may look at using a different type of method, some of the other methods here that we'll talk a little bit more about. But generic scores are a really great way to go when you're first moving down this path. But I also want to talk to you about another option that might be at your disposal, and that's called a judgmental score. And I know when you first hear the term judgmental, people have a negative connotation of it. They're like, oh, it's judgmental. What exactly does that mean? And it's more indicative of how the score is derived. It's really based on the judgment or the experience of the credit executive that's actually developing the score. And that means that the attributes, the weightings, and the scaling is handpicked by that credit executive or groups of credit executives based on their perception of risk for their business, their industry, and perhaps based on their own experience. And that's the difference. It's not based on any type of necessarily a statistically based analysis. And the purpose of these types of scores is not to predict a specific outcome, because again, it's not based on any necessarily statistical analysis. It's more designed to rank order accounts based on the perception of risk, again, in accordance with that credit executive. And over on the left, I included a sample judgmental score, something very simple just to provide an example here for those just trying to better understand how something like that would work. And if you look at the example, you can see we have 3 attributes that have been handpicked. There's years in file, IntelliScore Plus, and financial stability risk score. And each one has an associated weighting. So I can determine as an individual which factors or which attributes are most critical, and I may give more weight over to another one. And the other thing that we can do is create a scoring scale and point distribution system. And that typically says, based for this attribute, what do I consider low risk to high risk on that spectrum? And how do I perhaps assign point systems to that to be indicative of that risk? And what will happen is when a new account comes in, you would apply this scorecard, and you'll look at each individual data attribute and in essence calculate what the points would be for each one. And overall, what will happen is you'll develop a composite score. And in this example, you'll see a score scale of 0 to 10. 0 being the highest risk, 10 being the lowest risk. And that's how those types of judgmental scorecards are executed and the scores are derived. And from there, a credit executive can align that with their decision as well as their decision ratings. So as you can see, some of the really nice advantages to this type of methodology is it's highly configurable for your business. We talked about compatibility or perhaps edge case management. This allows you to configure the things exactly as you see them within your own process. The other thing is it's not displayed here in the example I provided, but you can also include non-credit attributes. You can include things such as maybe financial statement ratios for larger customers that maybe you're taking an assessment of for enterprise and cash flow. Maybe you want to look at portfolio and aging attributes for existing customers, so you get more of a 360-degree view of both your internal performance as well as external performance data coming in from another type of credit reporting agency or data source. And that can be nice. There are some challenges, though, too, to consider with this type of method. Mainly the fact, as you can already see from that example, it's heavily dependent upon calculation. And sometimes that could be manual, depending upon where you are in your modernization framework. So lots of times we'll see someone with a worksheet or perhaps a spreadsheet that actually executes the calculation and the summarization of these data values. We have others that will look at more decision software purchases to help automate that collection. There's some really good software platforms out there today that can enable that, but that does usually come with some level of additional cost. Now, those two recommendations are really good out of the gate. Like I said, if you use those generic scores, you can look at something that's more judgmental based, where you maybe have a little more control over the individual data attributes. But another third option to consider is something called a custom model score. And it's very similar to a generic score in the fact that it's based on statistical analysis, and there's typically a third party, perhaps a bureau or data science company that would build it on your behalf. But instead of it being based on the general business population or representative sample of the general business population, it's actually built on your own business and portfolio performance. So they will literally take your portfolio, analyze it, determine what risk factors are most indicative of the bad definition you're choosing or you're trying to prove out, and they will weight and develop the scaling around that model and, in essence, build it from the ground up. And typically, the purpose, again, is to define the probability of that specific outcome. Lots of times we see it built around the same bad definitions you would see a generic score have around severe delinquency, bankruptcy, default, failure, very common. The advantages to using something like this is they're highly predictive because they're based on your own portfolio's business performance, and it allows for optimal business application. We all know that as you start becoming more score-based and it starts impacting your day-to-day credit decisions, it's going to impact where you book your revenue. It's going to impact your profitability, where you're going to have your losses. But by having that type of science and background behind it, it really allows you to maximize that. So even though there may be some challenges around the initial cost to do the analysis, to do the build of such a score, to then deploy it through technology and ingest it, it actually has very good return on investment. And there may be some additional wait time around implementation. I will say that even though the first two options we were talking about are more commonplace, I'm seeing a lot more trend in the industry toward even doing this if you're even new, relatively new to the process, because there are folks that see the value here and are really trying to put in more of an analytical expertise into their process in order to get the best results possible. So we're seeing more and more of a trend here. We're also seeing new technologies that help to drive out or reduce those challenges around cost and implementation time, which becomes really, really valuable. The fourth option I want to talk about, and this is really critical in today's economic environment, is more around being able to apply scores for portfolio management. I think many of you are all probably a little concerned around with COVID-19 and sort of this discussion of a recession due to all the demand that's being taken out of the economy. What's going to happen? How do I manage my portfolio more effectively and more efficiently? One of the things to think about is not just a scoring risk score strategy on your front end, but maybe also consider it on the back end. So that means you can apply risk scores to an entire account portfolio in a batch or a bulk format. And once those scores are applied, you can then run segmentation and trend analysis to spot risk in your existing portfolio base. And over time, take action accordingly to potentially limit that back-end exposure, or maybe to increase sales capacity in areas where you think there's less risk. And this creates a really highly efficient, highly cost-effective way to start managing that process. And I even included a little snippet here of just something simple we do with some of our clients today with generic scores, where we provide IntelliScore Plus and Financial Stability Risk Score in more of an on an X and Y axis and just plot them out. And we can get an idea of what segments of that portfolio are stable and low risk of both events for delinquency as well as default and bankruptcy. We can see where we have high risk, which is maybe where you want to start monitoring those accounts much more closely, start taking action, start managing those relationships more proactively. And then maybe there's a segment that may slow pay, but you know they will pay. And you can better work with those when it comes to collection strategies, et cetera. And that's just a very simple example to get you thinking about how you might be able to extend risk scores out from just the acquisition phase of your business. So just some parting thoughts here. When you start making this initial transition and taking this first step, know your options. Educate yourself about what's out there. Hopefully a session like this gives you some basic ideas. I know it's only 15 minutes. I could probably spend 3 hours to give you a little better education on what's out there and what might be the best fit for your particular business, and most importantly, your comfort level. Also be realistic with expectations. You're going to set goals and milestones on how to make these conversions, but be realistic knowing that you're just starting that first step in your modernization process. There's a lot of other steps that you can look at. Try not to go from 0 to 60 in under 3 seconds, and do it at the right pace for your organization. Last, but definitely not least, seek the right partners. You want somebody that's flexible, that has expertise in the space, but at the very same time really keeps your best interest in mind, especially if you have a plan on how you want to approach that path to modernization in your own company. And that becomes really, really critical. That being the case, I want to thank you today for attending our Sip and Solve session around risk scoring and ways that can help to improve your B2B credit approval process. If you have any questions or want to learn more about B2B risk scoring options, please feel free to chat with us at that link below. We also have a lot of upcoming Sip and Solves, so there's a list out there that you can also visit via that link. I have a lot of peers that do ongoing educational sessions, so please come back and visit with us. But I definitely appreciate your participation today. Please stay safe, please stay healthy out there, and if there's anything Experian can do for you, please feel free to reach out and enjoy the rest of your week. Thank you.